One of the major frustrations expressed by doctors is that they're paying too much tax. Indeed, if you're a medical professional earning large amount of income, you have to give away almost half of your earnings to the tax office. And if your income is coming from your own personal exertion, there is not much you can do to avoid being taxed on it personally. Fortunately, there are certain strategies available to doctors that provide tax savings opportunities. I am Elena, a specialist medical accountant and tax advisor. Today, I'm going to share some very effective but perfectly legal tax strategies for medical professionals. Strategy number 1, using a service entity. If you operate your own private practice, you probably employ staff, including a practice manager, nurses, and receptionists. You have your business premises, medical equipment, fit-out, and IT systems. So you already have this value-added structure in place that helps you run your practice. Why not move this structure into a completely separate entity that's going to run its own standalone business of providing you with practice facilities and support functions? That way, not only can you relieve yourself from certain risks and responsibilities associated with running your practice, but you can also get a tax advantage from it. How does it work? You set up a separate tax structure, usually a trust or a company, to act as a service entity. The service entity owns the equipment, employs non-professional staff, takes care of leases and other contracts, and performs all the administration functions. You enter into a contract with the service entity to provide you with these services and facilities in exchange for a service fee, which is usually calculated as a markup on costs or a percentage of your billings. Provided that the service fees are reasonably calculated, they will be tax deductible to you as your business expenses. The service entity will return a profit which will no longer represent part of your personal services income, so it can be diverted to your family members or associated entities in lower tax brackets. Strategy number 2, taking advantage of negative gearing. Acquiring negatively geared investments, such as real estate property, can be a good tax strategy, especially for individuals on high income. An investment is said to be negatively geared if the amount of interest on the loan and all other tax-deductible expenses exceed the amount of income it's producing. For example, if you have a rental property, your expenses can include interest on the loan, agent management fees, council rates, strata levies, and other running costs. You may also be able to claim depreciation and capital works deduction on your property. These expenses are tax-deductible, but they are not coming directly out of your pocket. If your total tax-deductible expenses exceed the amount of rental income, you make a rental property loss. If you own the property in your own name, the tax legislation allows you to deduct these losses against your other income, which makes it a very popular strategy among doctors. It should be noted that negative gearing only works well for assets that appreciate in value over time. Obviously, you don't want to make a loss just to claim a tax deduction for it. So before you invest in any particular property, you want to be confident that the capital gain when you sell it, together with any tax benefits, would be enough to compensate for the losses you make during the ownership period. What about positively geared investments? Well, it's best not to have them in your personal name. They can be owned by someone in lower tax brackets, like a family member with low income, or they can be placed in a discretionary trust, giving you a flexibility of income distribution. Strategy number 3, making personal super contributions. Making tax-deductible super contributions is not just a very effective tax minimization strategy, but it also helps you build your retirement savings. If you make personal super contributions up to your concessional limit, you are allowed to claim that amount as your tax deduction. The contribution will be taxed at just 15% inside the super fund, or at 30% if you earn more than $250,000 in that year. But when your marginal tax rate is 47%, it results in quite significant tax savings. For example, let's say you earn taxable income of $200,000 in a year. If you make a tax-deductible super contribution of $20,000, your taxable income will be reduced to $180,000. Every dollar you make over and above $180 is taxed at 47%. So, by making a personal super contribution, you will reduce your tax bill by 47% of that contribution amount. The contribution will be taxed at 15% inside the super fund, so the net tax benefit you obtain is 32%. Now, what if your taxable income was, say, $300,000? In that case, you would have to pay an extra 15% on your super contribution. This is called a Division 293 tax and is currently applying to people having an adjusted taxable income of $250,000. Your net tax benefit of making a deductible contribution is reduced to 17%, but the tax saving is still considerable, so making a contribution is still worthwhile. Strategy number 4. Using tax-effective debt structuring. When you take a loan to buy a business or investment asset, you can claim a tax deduction for the interest you pay on that loan. But when you buy something for your private use, the deduction is not available. So, ideally, you want to minimize non-deductible interest and repay your non-deductible debts first. Couple of tips here. Firstly, avoid mixed-purpose loans. Never ever withdraw your investments or business loans for private purposes. If you have a mixed-purpose loan, your interest expense will not be 100% tax deductible, and if you make any repayments, they will be applied to reduce your taxable and non-taxable components proportionally. You can't choose to allocate your repayments to a particular portion. What you can do is to refinance your mixed-purpose loan into separate loans. Secondly, use an offset facility instead of repaying the loan balance. By parking the available cash on an offset account, you will reduce your interest charged on the loan, but you will still have the ability to access this cash if you need it, without compromising the deductibility of interest. These are just some common tax-saving strategies for doctors. Obviously, they may not be appropriate for everyone. If you're a medical professional and if you would like to discuss tax strategies for your specific circumstances, get in touch with us.